Welcome to the Atomic Level, the show where we decode the matters of wealth, one insightful conversation at a time, with the rising stars and bestsellers in finance, business, and tech on Substack, so that you can grow and protect your net worth, and most importantly, your net happiness. I'm Chris Snook. Today, I welcome my new friend, Henrik Zeberg from Copenhagen, Denmark. For those who are tuning in, if you haven't been to that country, we were just nerding out in the green room of some really wonderful memories I had there. Henrik, welcome to the show.
Thank you so much, Chris.
I'm really looking forward to this one, and you've been doing really well. I think you were, as I checked this morning, in the top 50. I know you've climbed higher than that. You're a bestseller. We're going to find out all the reasons why today. But as the audience knows, and as the live room fills up, if you're listening to this on replay, we're going to start with the man and what shaped his worldview. So just give us a sense of that and where you came from and kind of what shaped your worldview. Then we'll get into the operating system and kind of the strategies and all those good things.
All right. Yeah. So who am I? I grew up in Denmark and not even in Copenhagen, a small part or down by the border to Germany. I studied economics at the University of Copenhagen, and that was back in 2000 when I got my master's degree in economics there. And then I started out on a journey where went into consulting and did a lot of mergers and acquisitions with various consulting companies, and did well for myself as a consultant. 2005-6 came along. I turned 30 in 2005, and the banks were all over. If you've done well for yourself as a consultant, you had your money. You could borrow money for any kind of real estate kind of investment you wanted. So I dived in deeper there and didn't think much about it, because you can always, excuse yourself and say, this is real estate. You can always, if you invest deep, you'll just have to wait it out and everything will be fine. And all of a sudden we saw the financial crisis unfolding, and I was like, how could we see this? And it caused me a lot of trouble, let's just put it like that. And so when I experience something like this, I just don't let it pass by and say, okay, why didn't nobody really see what happened here? And why did we almost run the economy over the cliff? And then I started to dive into what and how and who actually saw some of this. And that was the start of my journey, really. And this is where I started to think of, if you've seen people not seeing this, how can you then trust them the next time? So you had Bernanke standing there in February, March of 2008 and say, oh, we don't think there's a recession will hit us. And we were 3, 4, 5 months into it. So what is it that they are looking at, and why didn't they see it? And it was, widespread. It was the whole financial industry. Nobody actually, there were of course a few, but the 80, 90, 95% didn't see a recession at that point, which was the largest we've seen in many, many years. And so I started to dive into that and try to understand having a degree is not the same as really understanding things. That makes set you up for understanding and to study more. And I started to study business cycles and that kind of, because I could see that there was a fluctuation of things. If you take the non-farm payrolls and you put in a 12-month moving average, you will see the business cycles actually turning out there right in front of you. And apparently that was not something they were looking to. So I dived more into it and said, what is that you need to be aware of if you were going to see a recession? What is it that can be? And this work actually, took me, I would say 2018, 19 was probably the time where I started to say, okay, now I have something that is, viable, strong, foundation, because you don't start on day one and then next day you have something. It takes a while, right?
Yeah.
And so I did that. And that's how I ended up at where I am today, where I focus on understanding the business cycles, because I think it's something that has been forgotten. It has been, or not studied, I don't know. And it's like everything is about liquidity. And if you have liquidity, it's actually being seen as the business cycle, which I think is completely wrong and dangerous, by the way. And then we've had this, I would call it regime, the environment where apparently money printing can fix everything. Throw some money at it and then everything will be fine. So this is what I use today, my business cycle model, my macro navigation framework, because it's more than that. and then have now started to also connect it to the markets and to understand that when you are in different phases of this business cycle, there is actually the industries you need to be in, and that will actually give you a very, very good or outperformance of what you else would see, what you would see in the markets if you are. And you don't need to, be in and out, and you don't need to sit and study whatever Hormuz is, does for the economy, because by the end of the day, it's really about something quite different from what we hear in the news on a daily basis, and that's about the ordinary people, the ordinary American person, sitting there having a job or the mortgage loan and so on. And if Mrs. Johnson there is not feeling good, well, then, by and large, you would see very often that the economy is not doing well. And there's nothing AI can do about it, in the short term, or that the Fed can do in the short term. And this is something that I think is very forgotten. And that's where I stand. That's how I base my work on.
Well, and it's interesting to speak about this with someone who grew up in Denmark and who currently still lives there and has operated there. Have you always been a entrepreneur? That's number one. And number two, for the last 10, 15 years, every major publication that talks about places to live or money has ranked Denmark as one of the happiest countries on the planet, if not the number one place to live for happiness. I had a week and a half there in the summer of 18 when we lived in Europe. So I had a little bit of on the ground experience, and I could see why some of those things are true. I also had questions of how true they were, because, it's not exactly inexpensive. I want to hear from you, kind of as you keep going a little bit into this worldview before we get into some of the frameworks that you're talking about around liquidity and some of these other things.
Mhm.
I want to hear from you, like, how truthful you think that is. In other words, is that, accurate? Most of the people I've met from your country are lovely and happy and seem to be the
Mm, mm,
but, just like over here, when you said Mrs. Johnson or Mr. Johnson
mm,
or whoever
mm,
is trying to fill up their gas tank or do that, and they're kind of getting this gaslighting of the economy's
mm,
great. You're like, well, it
mm,
doesn't feel great to me.
Yes,
Is
but you're
that
hitting by
is
the
that
yeah.
in your country or in your region, or is it different? And if so, why?
I this is where it's very, there is a big misunderstanding sometimes, I would say, in terms of what I mean. I'm not a communist. I'm not a socialist. I can promise you. I believe in that, everybody should be put out there and try to do their best, and then they will be working for, trying to maximize profit and all that. I'm a capitalist, no, 100%. What I do believe in is that there are some things that need to be in place in a society. And if you can have a society where I pay a heck of a lot of tax, I can promise you that I pay 50% of what I earn in taxes. Okay. So that's a lot. Uh, but I am actually, and I say that, and as a young man, I was saying, oh, I don't want that. I want like the US. And I look up to the US in many ways. Um, but I'm honestly also very, very happy to live in a country now and in a city where we don't have I mean, we have homeless people, but they actually do have a place to stay also, and they will go there. We don't have we're not afraid of sending our kids out on the streets. I mean, of course, we can have situations where stupid people or do bad things, but but by and large, we don't have a lot of crime, and it's actually very low. And I think the one thing we have in our society in the northern in the Scandinavian countries is a genuine trust and in each other, and actually also in the administration in the state. Have I voted for our current prime minister? No, I did not. Do I honestly think that she's trying to fool me? Hang on here. I was just did it for long. Do I think that he's trying to fool me or to screw me? I know, and taxes and so on. Well, of course, I think it could be done much more efficiently, no doubt about that. And I'm voting for parties also that looks into that. But it's not the same as saying by and large I enjoy the society. I don't come from a family of wealth. I do not. I came from humble beginnings, and I earned a degree at the university having zero debt in student debt, zero. When I went out, I actually got money going through university from the government or from the state or whatever, which I'm now paying back. So I'm now paying for people going to and I'm actually happy to pay to people that as young people that come growing up. And, obviously you have people that don't spend it in the right way, that don't use it and all that. You have people that takes, the education that goes out the country and moves to the US. And I have several friends who live there in the US now. But the thing is, I'm actually I feel that I'm a part of something where we lift each other, and I was lifted by the Danish society. I was lifted by that because I'm not sure I would have had an education as I have today and have been able to do the same. So if that is happiness, I mean, there is at least something that is good and secure. It's a good, nice, secure feeling about it. But are there things that needs to be improved? Yes, obviously. And there are things that needs to be much, much better. Are we the happiest people in the world? I don't. First of all, I think it's the Finnish guys. But hey, and but anyway, but then again,
Fernando in the chat said that it's Argentinians, and I don't disagree. That
okay, oh yeah,
was a great win yesterday.
That was a great win. Yeah, it was a great win. But so I don't know about that. I mean, I have nothing to compare that to. But I think it's probably around. It's about that. I think it's about that you feel, even though you don't have the prime minister or the person that the politicians that you want in power, that you still see that you can grow up and you can be, and things can become better for you, and you will be taxed. Yes, no doubt about that. And then the moment when you start to see that you actually have gotten something for them, that money you pay, that I pay today, and I will also in the future, and my kids will, and so on and so forth. Well, then it's a different kind of feeling. Maybe that's it. I don't know why we rank high there.
Well, I think you hit on that. I think what it comes down to, and every market needs this, right? You cannot have a functioning market without trust. There has to be trust. And function can be defined by a lot of different things, but one of the functions of a free market is to provide upward mobility and access and opportunity. And those things are not synonymous, in my opinion, they're not synonymous with entitlement, right?
Mm-hmm.
They're different. And so when you have it working in a way where, again, you can see that you stood on the shoulders of something else, the state, others, generations before you, because of the common sacrifice, and that there's this common lift, then that usually means people are generally more happy, more proud, and they have a sense of that. I don't think we've lost that totally in the West. I don't think we've lost that in other areas. I think there's no such thing as the panacea. I think what we have done is we've marketed that, just like in Denmark, right? It makes sense to say, hey, we're the happiest place because you're trying to attract more talent, more people, right? Those are inputs to the machine. So I think if we take it with a grain of salt, but we just look at what is the common thing is your experience. And if that experience is there, then typically that country is on the rise. And if that experience is missing, then it's probably heading in the wrong direction. And that can happen under any regime, any.
Oh yeah, absolutely.
That is not limited to one side of the aisle or the other. So, all right. So that helps us understand kind of who you are, where you came from. Let's talk a little bit about your operating system and how you think about markets. Let's go deeper on whatever you want to start with, whether it's liquidity, whether it's the business cycle, whether it's debt loads, whether it's CapEx, whatever it is. But talk to us about your framework and how you think.
All right. Yeah. But so first of all, how I think, it starts out by GDP. It's all about growth, right? It's about how do we generate growth. If we have good growth in the economy, you will often see that the financial markets do well. That's one observation that I made very, very early on. And when you have good growth, you'll normally see that, especially in the US, where you have that the largest growth component is private consumption. It is 70% of GDP. So it's very hard to see that an economy can do well if the consumer is not well, because it's 70%. You cannot export it all, because there is the private consumption, there is private investment, there is public consumption, and then there is net exports. And you cannot just export it all out. You can be like Singapore, you can have a lot of exports, and it can be driving the main part of your GDP. But you cannot be the US and do that. You cannot even be Denmark and do that, even though we are just 6 million people here. So you need to have, the consumer needs to be good. When is the consumer good? Well, the consumer is good when the job security is quite good. They have a job and they can find a new job if they want to, and they earn good money. And also if the housing market is okay. These are actually the two most important components of us, as human beings, as consumers. We want a job. We need our house to be rising slowly, steadily in prices. And then we have the other components, which is investments and public consumption and so on. That's all good and fine, but it's really about the consumer. And if we look to that, we can actually see that if you go to GDP and to the job creation, you will actually see, and I actually have if you just bear with me just for a second here, I can see if I can find that particular chart there. Then you will actually see that there is a very, very close correlation with the job creation and the GDP and the year-on-year GDP in the US. So here we have the blue line. Here's what I say, the non-farm payroll as a labor force ratio. That means that a labor force right now of 170 million should be able to create a certain amount of jobs, which are, everything else being equal, more than a labor force which was 150 million going into the financial crisis or even before that. So we need to understand that that's a ratio. It's not just, a fixed number, 50,000, 57,000 non-farm payrolls. Is that good or bad? It depends on how big, the economy is. For Denmark, it would be fantastic. For the US, it may not be so fantastic. And if you look at that, you can see how closely they correlate. And there is a reason for that. That's because when the economy is well, that's when the labor market is able to create a lot of jobs. I'm not saying which one is leading and so on here, just saying there's a very close correlation to it. And you start out by that, then you understand that you can also see that there are some cyclicality to it here. I mean, this is the business cycle we look at right there in front of us. So if we strip it down to these things and say, well, first of all, what is it that is important for the economy? Is the consumer. It's about the consumer being well. And you then start to focus on what is then happening in the housing market, which was Michael Burry's also approach back in 2005 and 6. And he said the market is crashing. It's going to hit the economy. He was right, but he was early. The next level he should have been looking at was actually the non-farm payroll, or actually just the labor market, which actually held up for quite some time. If we look to the numbers today and what I just showed you here, that ratio we're looking at is not really good. And this is one of the things why I'm a little more skeptical about what we see right now, is because the labor market is actually in the US not in a great state. It's actually in a bad state. And the same goes for the consumer. So I can maybe take it a lot too long to tell, everything about my framework, but by and large, it is about understanding that there are business cycles that are dependent on the wealth of the consumer, which again is dependent on the development in interest rates, which goes up and down. But it's not down to if the Fed is cutting tomorrow or they are not cutting. It's a little bit bigger than that and larger than that. And that's where the cyclicality comes into it. So if you look to it, there is a cyclicality to it. There is a certain amount of leading indicators. There are some that is coincident, which means this is the economy. Now, let me just show you another chart, and I hope I don't bore too many. But this is, just again to do it, and you can say on the surface. But this is really my model, just in a summary here. You could say you have the leading indicators index up here, which it's a proprietary index that I've been building, which simply tells us where the economy heading. And it doesn't tell us when we're falling into a recession. It tells us when we have a slowdown. And in 2024, in Q4, in November, actually, it crossed over in the leading. And I started to say in there, we have an economy that is now declining, that is in a slowdown. The problem comes only when this slowdown leads to a crossover in what I call the coincident index. And that is when, so to speak, the shit hits the fan. That is when the economy has been deteriorating through the slowdown. I remember last year in 25 when Powell was standing there in Q1 and Q2 and said, we have a fantastic economy, fantastic job market. And we could see the non-farm payrolls were just showing a fantastic growth. And then came August last year, and we saw this 1 million jobs actually being evaporated from that revision. So the economy was not well, and it's still not good. And now we're starting to see that crossover, which we have only seen going into a recession. There's never missed. You can see when the red crosses here, we see that there is a slowdown, which leads to a crossover on the coincident. And the coincident is actually then the call for the recession. And it normally leads by, let's say, 3 months before we see the recession being, is beginning in the US. And so this is the framework. And then, of course, we cannot look without liquidity. But liquidity itself and not do the job in any way. So if you look to my liquidity indicator, you could see how everybody who was calling, and I did not, I just want to say that. Remember 22, when everybody was calling for a recession back then, it was so clear that there was not a recession coming at that point. The leading index was up here in this area here. And in fact, the coincident index was still rising. And yes, liquidity was bad, but liquidity is, as I said before, not everything. It is important, and if we have a crossover now with the current setup on the business cycle model, then it's completely different. But we are not there just yet, and we don't see what I also call the imminent recession indicators. I have some indicators that will flash the moment we see a potential recession setting in. But structurally, we have a situation where it's really not a good situation. And and I'll just pause for a sec here just to leave it up. But this is in by and large to understand the setup and how it works. Oh, I cannot hear you right now. I think there's something.
Oh, sorry about that.
Oh,
My mic cut out. I'm really glad to see that. I want to poke into that a little bit because there's some really well read stuff out there, and I've had several people on the show with different angles of this, and I kind of like your coincident index. I like kind of how you're looking at these things layered on top of each other because I'm interested in the nuance that you see. So here's a couple questions. So one, if you're familiar with Raoul's work, like Raoul Pal and kind of the universal code or exponential age and all that stuff, the chart that he shows a lot, especially when it relates to assets, whether it be crypto or the price of Bitcoin or NASDAQ, is liquidity and that, and they basically look like a mirror image of each other, right? They're like almost neck and neck. And so liquidity plays a role when it comes to asset prices at any given time. It appears because the correlation is almost exact. However, what I see in your chart is saying it is not enough to predict the overall health of the economy. So, and I agree with you in that lens because when I think about the economy, I think about decay. Not It's not one economy, right? You have Wall Street, you have Main Street, you have asset owners, and you have people who work and don't own as many assets.
Mm.
I'm curious as to when you speak about the economy, are you talking about those two disparate classes of people, asset owners and who make their living basically investing, and others who basically may have some assets that they've been able to accumulate very slowly over time, but they primarily fund their living through labor and through work because those two economies don't seem to be operating under the same set of rules.
Absolutely not. And the thing is, we seem to believe every time that it's the financial world that will be pulling the rest up. But it always shows that it's actually the real economy. That's why I say Mrs. Johnson and Mrs. Jensen here in Denmark that are the real economy. These are the real economy. Their well-being. And right now in the US, unfortunately, and I'm not happy about this. I mean, I'm not thriving on this. I mean, I am, as I said, I come from humble beginnings myself. It's the top 10% of the US population is doing fantastic. But you have 45 million people in the US who have severe problems of putting food on the table. You have up to 7 to 9, 8 million people who actually get too little food on the table. And that's not pointing fingers. It's just to say 53 million. That's a lot of people living, in not in a good situation. That's not just about inequality. It's actually something where you could see if you go also into the next level of the consumer base, you can see that they are also fearing losing their jobs. They cannot spend as much. They are up to here in terms of payments, interest payments, because the interest rates are so high compared with that debt that they have. So when I hear these people talking about the whatever code it's called, honestly, and I want to be frank, and I don't, but it's marketing gimmicks. And I want to show you that chart. Actually, I don't have their liquidity indicator, but I've heard about liquidity for such a long time. And let's just look at it, because I know that chart that you're referring to also only goes back to 2011. If you look at that situation where it actually go further back here, this is the chart if you go further back. And let's just look at that for a second and say we have what is the M2 here then, and we take that as at least an indicator for what could be liquidity. And I remember the dot-com crash. That happened while liquidity was rising. And this is just a lock chart. And I can see, oh, wow, nice correlation here. I can see that as well. This is actually the GMI chart from two. Not it looks like that, like what
Yeah.
they have. I don't know there.
Yeah,
It's
that's
similar
GMI.
to
Yeah.
that.
Right. Yeah, that's GMI.
It's
Yeah, that's
it's
right. Yeah.
so, but just what then happened there? I mean, you have M2 going up straight. So what you're saying is actually, as we look at this, the theory is dead in its birth here. It's not existing. Oh, so we are saying, okay, on a long term basis, that there is a correlation between the amount of money in the system, whatever the Fed's balance sheet, M2, and whatever. Of course, there is. I could have shown you
Yeah,
that as
yeah, and
well.
I could argue that if you took the blue line and you smoothed it, right,
Hmm.
that there would be roughly, looking at my screen, there'd be roughly like a centimeter difference, right, between the red and the blue if you just smoothed them and you went parallel. So the
Hmm.
argument could be that they do correlate very tightly, and that value prices are more volatile, but that kind of trend slightly north of the liquidity bar. You could make that argument without too much. But I think your point is that it's not a great predictor of where.
No, it's terrible. It's honestly terrible. I mean, you cannot tell me that here, if we have used that as a predictor and said, "Hey guys, everything is good because the M2 is rising," or whatever liquidity indicator, I would say that is BS, honestly, because we had one of the worst crash here, and especially in the real economy, and a lot of devastation was going. I mean, that's like saying the financial crisis was a nothing burger. It was
Well,
not.
it also
It
it
was.
also doesn't necessarily take into effect. I've written about this about a year ago. I think I wrote kind of a couple pieces about it around the Cantillon effect, right? In other words, the proximity to that liquidity matters too, and most
Mhm,
people in the
mhm.
real economy are not in proximity to those liquidity
Okay.
surges, and so it doesn't necessarily touch them directly.
Right. But you're spot on. I mean, it's spot on. Again, I mean, it's like sitting in your Eiffel Tower there and say, "Oh, yeah, no, from up here, everything looks fine. Everything is great. Why would the economy crash?" And by the way, if we compare two lines with each other from 2010 and 11, everything looks, all nice and dandy. So all the things we have had before in 2008 and to, financial crisis and the dot com and what else you know, we have, gone away from. We don't see that anymore because we are pushing the M2 up. If you're in that belief, you really think that we can just eliminate recessions and crashes because by printing money forever. If you think that, then I think you need to dive a little deeper of what is the next thing that comes when you've done that for some time. Why wasn't it that our ancestors were not idiots? I mean, it's not like granddads. They didn't understand that if they printed money, they could initiate some stimulus that would actually work well for the economy for some time. Guess what? That's what you did in France, and now we have the Bastille Day right yesterday, right? And that was what they did also there. They, let the printing press run. And, people weren't able to buy bread back then because, prices went up. It doesn't harm the guys to sit there in the Eiffel Tower and have all the assets and say, in the long term, if you just hold on to your assets, you'll be fine. The economy is not the financial world. And this is the problem. This is what they don't understand in the Eiffel Tower. The real economy is the Mrs. Johnson and Mrs. Jensen again. And if you focus on on those two levels or that segment, you will see that they are not well. And there are four phases in my model that we've looked at. If you see, it's a cyclical model. And if you look to a long-term trend and you kind of put the cyclical model there, you'll say there are four phases: above the equilibrium, rising, falling, below, above, four phases. These four phases, in the three of them, liquidity is everything because that's where the economy is well. So if you pump the system with liquidity in those three phases, everything is fine and you'll see the markets going straight up. But if you believe that is also to be the truth in the fourth phase, you can just go to this chart that I just showed you and see what happened then in 2007 and 8, where this actually completely it doesn't exist that kind. It was quite the opposite. They were pumping money into the system into 2008, and yet we had the crash there. The same thing into the dot com. So as I said, the theory is dead in its from the beginning and from the
Well, and
get go.
if you were to look at that through, I don't want to say the lens of power or conspiracy theory or just opportunism, in that fourth phase, when you pump liquidity and you apply like the Cantillon effect to that understanding, you recognize that when asset prices are at their worst, those who already own a bunch of assets have the most access to liquidity and then can acquire those
Mhm.
distressed assets in that period.
Exactly.
And then over the long term, that wealth gap, that K-shaped recovery gets wider.
Mhm.
And that's what drives it, is that you have this fiat kind of print your way out of the mess doctrine, but it creates this natural inherent gap
Mhm.
in
In
accumulation.
the society, yeah,
And
and it's in
and it
between. Yeah, sorry.
Yeah,
Go
and
on.
then no, I want you to run with this,
Mhm. Mhm.
and then it drives towards a populism after the fact, where those who benefited from that can now harden their power by basically saying to the people who were harmed by it, "We're gonna
Mhm.
fix it for you because
Mhm.
this is wrong, and the billionaires should pay more money in taxes and this and that I will
Mhm.
direct
Mhm.
so that you get a benefit." And again, that is not free market. That is not
Mhm. Mhm.
that is just another form of essentially the referees now trying to become the players on the field as well, while the
Mhm.
rest of everybody else spectates and wonders what's gonna happen at dinner tonight.
Yeah,
And
exactly.
and I say that in as many layman's terms as I can, because we've gotten to a place where now the referees have kind of decided they wanna be players and on the field a little bit more and more important in the game. And I think that's playing out in the West. I think it's playing out in Europe. I think that's
Mhm.
playing out in a lot of
Mhm.
places. And meanwhile, the spectators are going, "Dude, I can't afford the popcorn."
Exactly. But that's the point. And again, by the end of the day, I will promise you that within not a too distant future, you're going to see that it'll be the actual world, the real world, like the moms and the pops, the Mrs. Johnson, and so on, that will drive the direction of the market. That's my theory. That's based on the business cycle, because we have just entered now the phase where that is going to play out in its full, and we are in that contraction phase.
Well,
This
then I
is where
wanna
the
shift
economy.
it to that. I wanna
Yeah.
shift it to your strategies then. So
Mhm.
if that's true, and I'm gonna
Mhm.
try that one on, right, and put that on and say,
Mhm.
let's say Henrik is
Mhm.
right.
Mhm.
If that's true, what are the strategies that you are using to invest into that truth? If that's what you see as the next phase, which you do, how are you investing into that? What asset classes? What are you staying away from? What do you think is exciting that other people maybe think is over,
Mhm.
or vice
Yeah.
versa? However you wanna answer it.
Right. So first of all, there is a even within that phase of that my contraction phase, the third phase, it will not. First of all, let me just say, because people wake up tomorrow and say, "Oh, he's wrong because the market's going higher." Let me just say, my outlook from here on is that we're going to have this now very crazy spike, like we always see. I mean, we've seen into these big tops. We always have a crazy spike. You saw it in 2001. This is nothing, minor to that, or more than what we saw back then, or we saw it in Japan also in 1989. I don't even want to compare to 2007, because that was a different period and different species in terms of what we see. But the speculation in the labor, sorry, in the stock market, in the financial market, is comparable and even worse than what we saw in 2001. And I mean, who am I? But Warren Buffett is saying the same thing, and I think he's very right on that. So we are going to see that speculative phase going up. Is that because the economy is strong? No, it's because the economy is weak. And that's because the Fed now, which I've been saying for quite some time, is going to come out and actually understanding that inflation is not a problem. We saw that yesterday now, and it was the day before yesterday. It has been so clear, because when the labor market is turning down, that's also what you can see from, if you just study, you can see that when the late my ratio there, the non-farm payrolls as a part of the labor force, you look at that, and when you see that starts to cross down through certain levels, you'll see that then inflation starts to drop really fast, because who is carrying inflation on? If I mean, now you have an oil price shock, right? And you need to fill gas on your car. You and I mean, I don't get another $1,000 a month. All of a sudden, I can start spending. I have to prioritize my money and say, hey, now it costs this much to fill my car, so I need to prioritize other things, or I need to fill a little less fuel on it. This is the this is demand destruction, and the only reason that people are fearing this, because they say, oh, but yeah, look at 1970s, like we had the same. That's not the same. Back then, the savings rate of the ordinary Americans was between 9 to 20%, which means that every time you got in some kind of a shock like that, you could dive a little deeper in your pocket. Today, the savings rate is between 2 and 3%. So there's no savings rate to go in and dive into. And the reason it's lasted a little longer this time, since we've seen this price shock that we saw the inflation, is because, again, Mrs. Johnson there, she had a lot of stimulus checks, and she's been spending that, and she's now, depleted all that spending and all that, kind of buffer she had. So the thing is that inflation is not a problem here, and we are seeing the economy starting to roll over. How do you then use that? What is it that you want to be into? Well, that's where my model also it's pointing to. Let me just again share here if I can find it really quick. And so the thing is that you can actually, through my macro navigation framework, we can actually take an aggregated look at it and say, well, there are different phases. There's the expansion phase, a slowdown phase, a contraction phase, and a recovery phase. And if you've been following that, and this is just you could say a hypothetical, and I wasn't, trading markets in 1975. I was 1 month old back then. So, not really what I did. But of course, this has not been retrofitted. This has been first saying, where is the different phases of the economy? And then said, okay, if you put on with the different phases a generic approach to the what you should be invested in, well, this is actually how you should be allocated, and that would have beaten the market by far if you had done like that. That is not retrofitting, because I'm not fitting it because of what we have seen of returns. I do that based on where the phases are doing that, which is only based on macro numbers, not on the market numbers like that. And that had given you that. So what you're saying is, I said, well, of course, I think the bond market, bonds are tasty here if you have that kind of appetite, and especially if you're looking outside of that next spike that we see right now here. I'm not saying it again right tomorrow. I say that there will be a spike into the market. It can last a month or 2 months or 3 months even. But I think bonds will be a good play in that contraction phase. I think that after that, also probably gold will be a fantastic play again when we see gold pushing down somewhat more, and we've seen the dollar pushing higher also, which I expect. So I think anything dollar denominated here, which is also kind of controversial. And again, also I want to say, I think the dollar is going to push a little lower here first, down to 93, 94, and on the Dixie. But you're talking about the contraction phase when it really gets going. That's what we're saying, and that's not today. That's a month, 2, 3 months down the road. And from that on, TLT. That's right.
Yeah, no, I think I want to keep going into this. I think that a good visual for everyone to remind ourselves of is when we're hearing these data points spouted out over financial media, YouTube, Bloomberg. I'm not picking on anybody, CNBC, anybody, right? Where most people hear stuff and get the feed, and it says the economy is this or the economy is that, or inflation is this or it's transitory. When we get those things, we oftentimes forget, like, well, what is the picture that we're looking at? So if you think about it like the human body, it's a lot easier. You can have someone who is midlife, 40 years old, in the best shape of their life, 6% body fat. You're a fit guy. I can tell just by looking at you. Like I'm reasonably fit. We're both right around the same age. I was born in 1975 as well. So we're doing pretty good in my opinion. But
I think so.
You could take a 45, 50-year-old man or woman, and they could be lean, be fit, they could be muscular, they could be strong, and you could walk them out on stage and they could have lost another 2% body fat. You're going, look at how amazingly healthy they are. And then walk backstage and they die of a heart attack.
Yeah.
And it doesn't make sense, because you go, wait, they were an athlete, they worked out, they lifted, they did cardio, they did all this. Yeah, but they had diabetes, or they had high sugar intake, or they had, in other words, whatever they were doing, or they were taking too many steroids, or whatever it was, they were doing something that rotted another important system inside the body that was not on the surface. And I think what you're getting at is that we have to take these things with a grain of salt. It doesn't mean that the person isn't lean and muscular. It doesn't mean the economy is not growing, GDP. It doesn't mean that the stock market's not up and to the right, S&P. It just means that's not the whole story of health.
Exactly.
And a lot of times the thing that actually drives the sustainable life of the human, or the economy in this case, is what's happening systemically inside that is not visible.
Correct.
And I think, to your point, we all can go, yeah, we think and know that we're focused on a lot of the muscles right now. We're looking at the tan skin, but we're not seeing the cancer cells inside. We're not seeing the heart disease inside. That's also
no, but I honestly don't understand what people are looking at. I mean, I can pull out. Let's just pull out a few things here. and then say, well, if you look to the first of all, again, the non-farm payrolls, just to say what is the job creation right now, in absolute terms, which means that this is it right here, and we have the fluctuation of it here, the monthly numbers. Then we have a 12-month moving average, which I've shown before. If you look to what we have right here, which is now at just around 60,000 a month, and you've seen this deterioration, which led to a recession, and here, look at where the levels were when the economy entered the recession. I mean, we are currently now at the blue line, and every time we were down at the blue line here back in previous times, and this is, by the way, real absolute numbers. This is not relative, which means that the economy was much, much smaller back then. Yet right now, we're looking at a number that is lower than going into recession every time here. And then if you look to another thing, let's look at the average weeks of unemployment. So when unemployment goes up, the number of weeks of unemployment goes up. That means that people are staying out unemployed for longer. And we see every time that rises, I mean, that is not good times we have here, because the gray areas are the recession periods. What are we seeing here? And I can go over and over on this. And again, as I said, with the ratio also before, saying, okay, now we make a comparison, also looking at inflation and saying when that, we have the ratio of the non-farm payroll labor force ratio and what does that does to inflation. Well, when it hits lower, you actually see that that's actually the time where inflation starts to drop. That's when you can also see it here, when it actually gets lower, you can see that the orange line starts to drop. So people are talking about inflation as that was a problem in an economy where it's actually the labor market. Just think about the Fed, the dual mandate, right? The inflation and labor force, right? They're focusing on inflation all the time. And there's no inflation because they haven't understood that the labor market is actually rolling over. As we look at it, unemployment length is going up, long-term duration of unemployment is going up, and so on and so forth. And they are sitting and looking at a non-farm payroll numbers, which are revised on an average by 60, 70,000 per month. And they look at 57 and say, oh, it's a great number. For an economy of 70 million, it's not. If you look to another number, you look to the participation rate of people, you can see that since November and December of last year, which is 6-7 months, 2.7 million people have chosen to leave the labor force in the US. 2.7 million. If you did not take those people out and you said, okay, let's keep those in the labor force, the unemployment rate would not be 4.2%, which is the official number right now. It would be 5.6%. 5.6. Why did 2.7 million people leave the labor force in a matter of 5, 6, 7 months? So I think people are not, as you said, they are not looking just beneath the headline. What is really going on? And I'm back to it again and saying the fluctuation with GDP and the ability to create jobs is what gives us the bigger picture. Well, right now, the job creation is plummeting. People are not securing their jobs, and that calls for a slowdown in GDP and a recession, as I see it. And I don't think Raoul Pal is one bit right that when the economy is dropping, that then all of a sudden we'll have an everything code that is being orchestrated by Besant or whatever he's talking about. And then that will ensure that we don't get a market crash, which we, by the way, saw in 2001 to 2000 and also in 2007 to 9. I think it's a fancy theory, marketing gimmick.
Well, I think it's not as clean as anybody would like, right? I have a deep respect for Ralph for a lot of things. I learned from him. I don't agree with everything either. I think when I look at that in synopsis, I say, inevitability. Yeah, I mean, we are not putting AI back in the bag. We're not, we're like, these things are inevitable. We're living in a token economy, whether we are transacting yet, the majority of that through stable coins or Bitcoin or anything else is not the point. The point is robots are not going to be using dollars, not over Swift rails, not 5 days a week with banking holidays, and robots are outspending humans at an order of magnitude. So when I look at
can we just say that
15 years,
that's the supply side. That's the supply side you talk about. That's what people are always going to. But the robots, the AI. But remember what they do. They help supply, which means that the businesses will be able to supply more, to have this demand and supply. It doesn't create another demand. It doesn't give Mrs. Johnson out there another $1,000. What it does is that it actually, makes her job redundant, and she will then have to spend less because, as you say, that the robots do not pay. Do I think AI is going to change the world? 100%. Do I think it's going to be the short-term salvation to the problems we have right now? Absolutely not. It's going to enhance them because
And
we're going to need fewer
I
misses.
tend to
Yeah.
agree. I tend to agree. This is why I'm saying I don't see it as a
Yeah.
lot.
Sorry, Anna, for interrupting.
No,
Yeah.
no, I'm glad you did. It's fine. This is my show. You can interrupt me. It's okay. I like it. So what I tend to say there is it's more nuanced than any one thing can be. I think what you're showing is that there. So if you took Raoul's thesis and you said, okay, what's right about it, and we just focused on that, well, there's an inevitability that's probably right about it. But the volatility in between here and there, call it 5 to 10
Mhm.
years, is going to be real. And that is going to be felt in ways that are very real by 95% of the planet and
Yeah.
95% of the labor force. One of the things I think he does touch on well that we haven't talked a lot about, but we're getting into with some of your work is the demographic issue, right? And that
Mhm.
force of labor participation rates going down, productivity going down. Now, if AI can help increase productivity, then it could end up providing us a savior that we don't have another answer for because for the last 2 decades, we have seen lower birth rates. We have seen those things, which is again a cyclical thing. It's not the first time that's happened. So a lot of doomsday around that, but this is not the first time we've seen that. Baby booms have happened before, not just in the
Mhm.
West, but in other parts of the world. So I'm not like trying to be salacious with it. I'm saying that those forces are also real and concurrent. And when you look at labor force and productivity declines and you see fiat printing going through the roof and fiscal dominance, there is this real gap.
Mhm.
And one thing, if anything could have a chance at solving it, I would argue AI has a chance, but it's not going to be smooth.
No, it's not.
And
And but I think that's about it. I mean, it's about perspective. If you say this is going to change everything and make sure we don't get a market crash within the next 6 to 24 months, I'll say no, it's not. I mean, have you tried to? I mean, I've actually been a consultant implementing some of these things. It doesn't happen overnight, and you're starting to
uh,
realize that the benefits are not the benefits are not that simple, and you need to have real people actually working with this, taking it in, and all. It's all nice and dandy on the top. And this is what happens every time you have a new technology leap. You had it, and now I don't want to sound. I mean, again, we can talk like that, but 1840s, we had a railway. uh, the steam engine coming out. It was a fantastic invention. I would say even all of a sudden you could travel across the U.S. You were building. That was one of the things that also made U.S. great, and growth went up because of that. Did it change the world? 100%. 1920s, you had electrification. Electrification. Did that change the world? Obviously. I mean, you could all of a sudden, you had the car, you had all these things coming out that was changing the world. Did we have a market crash in the 1920s? I think we did. Because what you saw was that the euphoria front running this and thinking, oh, we got it. It was actually a radio company back in the days in the 1920s that was the one that everybody talked about, said, yeah, this is going to be fantastic. And we can look back and say, were they right? Obviously, yes. But would it be the only thing and that, it was could justify the kind of valuation levels we were seeing? No, absolutely not. And
yeah,
that's what we have
I
every
think
time. And 2000 was another case, right? So do we see technologies changing the world? 100%. Do I think that's going to do that? Absolutely. This is one of the greatest advances in the of humankind or for all times. But that's not the same as saying that just because there's money printing, markets cannot crash. It's simply wrong. And it's
well,
that thesis
and
I just have to attack and then say I don't believe in it, and I think it's dangerous to say, oh, all of a sudden, and it's we're taking Mrs. Johnson out of the equation. We don't care if she has a job. We don't care if she has housing affordabilities in the gutter or the sentiment or whatever, because it's all about AI. That's where I stall and say that's not how the world works, and that's what I say we'll see once more.
yeah, and I think I think what you're hitting on that I'm really glad we're kind of hitting on it because I don't think a lot of there's not too many charts I've seen anyway that do a good job of narrowing into how in one jurisdiction, call it the US, you could have 20 major cities that all kind of look the same, and then you could have everywhere else. And those 20 major cities are major, but they're not everywhere else. They're not the
Mhm.
rest of the population. So even if those 20 major cities represent 15, 20% of the US population. The other 80% of the population doesn't live there, and they might have a different reality. And no chart ever counts that. No chart ever looks at those things. And this is where demographics, and this is where net migration, and this is where remote work, and this is where those factors play a role. They're both an opportunity as well as a threat, because now we live in a world where, again, you could work remotely and you could live somewhere maybe more affordable, and you could still make a reasonable or even a better than average income, but you're also kind of being forced to do that. Now, if all of a sudden those jobs get taken away because people want on premise again, then the impact's even worse, because now not only did that person lose their income, but they're now in a remote city where there's no comparable for that. And there's probably a lot of competition for other remote jobs that they could compete with. And now AI is coming in. And so you have what I call the white collar whiplash in a way this time around that I don't think has felt yet. And I've written about this a little bit. I'm curious your take. I don't think we're going to feel, and here's my thesis, and I could be wrong, right? But I wrote extensively about this looking at, I don't think we feel that till late 2027. And here's why. And I'm not calling it as a crash. I'm calling it as some kind of event that happens in the assets or the consumption patterns of the affluent, the mass affluent, which would be people that make a six-figure income as a household or better, and have been doing that. And the reason is because they may not have as much savings as they did, right? And we know statistically they don't. We've seen credit card rates rise. We've seen savings levels drop over the last 3 to 4 years, right? You probably have a chart for that. What we don't have is we don't have the check to check reality that you have when you have a blue collar recession, right? So like if you're a laborer and you lose your job, doing labor, the next Friday is a pain. Like you don't know how you're going to feed your family or put gas in your tank this Friday. If you're a white collar worker in your mid 50s and you've been in that gig for a while, making six figures, you probably have a retirement account. You probably have maybe an IRA. You probably have some savings. You might have an asset or two. You maybe have a second home. And so what happens is you lose that. And for 6 months, you lie to yourself, right? Because you go, well, I'm going to find another job.
Yeah, sure.
And then 6 months after that, it's a little slower than I thought, right? But now you're starting to move into it and you're holding on to things. And then 6 months after that, maybe now you've had to sell something you didn't want to sell, whether it was the second house or whatever it is, the tuition. Cut that. And so those second order impacts of that initial job loss or that flight of capital don't play out for 12 to 18 months because it takes you that long to admit that things have changed. And
I think you are in that process. I think we're
in that process now, and we haven't seen the job loss yet that might come, but we've seen some of it.
And but you have actually seen the job loss. I want to emphasize that. That's again where nobody really looks under the hood here. If you look to last month, there are two ways of doing the job report, and we always hear about the non-farm payroll. There is the other one, which is where we actually look at how many full-time jobs do we have. In last month of June, you saw a loss of 514,000 full-time jobs in the U.S. 514,000 full-time jobs. Where is that in the headlines? Where is that for the economists looking at? Nobody looks at that. And I just wonder why. We choose to look at non-farm payrolls where we don't know whether it's actually part-time jobs or full-time jobs. And we don't know if it's going to be revised. Last year, we saw more than 1 million jobs being revised in the terms of August. We ended up with 185,000.
This is a bigger issue, right? This is the bigger issue is what number do you even trust? Because if I can revise 1 million jobs, I mean, how do I know what's real? And
but
I think
that's
early on.
That's where my index, that was what I said back then when I constructed it and said, what is it that I can really trust? I cannot trust, one of them or two of them. I need to trust an index. So I need to, pull a few things together and say, if they show weakness together, then we are in bad shape. And that's what it does. So that's why I say when that crossover comes, that you need to take that seriously. And again, I was not happy to see, but we saw 514. You can take that. I have the chart as well. 514,000 jobs were lost, full-time jobs. Nobody speaks of that. That is not a strong economy. And 514,000 people not being able to, again, now, pay whatever. What they did, many of them was moving out of the labor force. We could see that 700,000 people left the labor force in that 1 month. Why? I mean, what is it that they are doing? I mean, is that some of the things that you're talking about there? They have been looking for a job. We can also see that the number of continuing claims have been rising also. It doesn't look good either. People are finding it difficult to find a job. So I think the process you were referring to is happening already. And I'm with you that at some point it's going to come through. The moment the businesses start to lay off people, and if I'm right that you're going to see now there will be a slowdown, there will be accelerating, you'll see that there'll be some cuts, and then you can see it actually, having a kind of a waterfall drop. So the process is ongoing, and you can actually watch it. There, the data is there.
Well, and I'm gonna use a little bit of a personal analogy, not because I think it scales, because I think it might talk about this in a more granular way and give you something else to run
Mhm,
with, right? So when you think about, like, if you were to genericize what happened in America in the last since COVID, right? So when COVID happened and the lockdowns happened, you had blue states, you had red states, you had everything else. Right now, the majority of this country, more than 52%, identify as independent, politically independent, right? But they're not necessarily heard because you pick one of the two poles and you hope for the least
mhm,
bad impact, right? But
mhm,
but more than half the country identifies as independent politically,
mhm,
and yet pragmatism is always a thing that plays out when things happen. So when the lockdowns happen, states that were a little bit more aggressive or even seen to be communist or socialistic about how they approach that saw net migrations, right? So between tax policies, between those things, you saw states like Arizona, Texas, Florida, and other places get a lot of net migration. Well, that obviously improved asset prices, right? I bought a house in Arizona in 2017, and in fiat terms, it doubled in 5 years, and I sold it in
mhm,
2022 because I'd seen this rodeo before. Now that house is
mhm,
still slightly higher than that. If I was to buy
mhm,
back into that neighborhood, it
mhm,
would make no sense. And
mhm,
so what happened was I arbitraged it, left the entities, left the Nexus list, all the business stuff, and I went back to the beach because I could buy and get a house looking at the ocean in wine country
mhm,
for a third of the price that the same house would have cost me now in Arizona in less than 5 years. And so the arbitrage became real, but I
mhm,
didn't wanna take all the other risk of moving my
mhm,
entities and things like that to California because who the hell wants to have a business in California, right? So I had to structure myself. My point is there's these interesting things that happen when people that understand what's going on make
mhm,
choice where they don't fly the general narrative of everybody leaves California. Well, yeah, maybe I moved certain things out of California, but I moved my ass
mhm,
back because it was a third cheaper for better lifestyle.
mhm,
And
mhm,
so what happens in 18 months when people start to look at their math and it doesn't add up anymore and they're going, "Well, I
mhm,
wanna optimize my happiness. I wanna live where I wanna live, but I don't wanna pay what I don't wanna pay, and I don't wanna, waste money on a house I no longer need. Do I rent? Do I buy?" And so these things are not gonna be clean, but what we do know is they have not yet played out.
mhm,
And part of the math equation I think that you're trying to help people grok is when they play out, where is
mhm,
the opportunity? And
mhm,
and then how do you apply that at the local level? Because most of what
mhm,
we see in mainstream media or even in Substack around finance and investing is genericized to not even a local level, like a global level.
mhm.
And
Yeah,
it's just
sure.
not reality. Like the real people live in neighborhoods. Real people put
Absolutely.
part of their money in a zip code. They don't spend the majority of their money in the macro.
Exactly. No, no, no. And I think that's the real thing. That's the real world. And again, it's down to what is going to, by the end of the day, going to be driving the everything we're going to see. Is it going to be the fancy theories of why everything can keep going up? Is it because of AI and all that, or will it be down to that people will make decisions down to the individual? And I think I don't know much about you, but I'm sure that you are in the upper part of the American society when it comes to standards or living standards. And I'm sure there's a lot of people down there where it's like dominoes that, if they don't feel good, they will spend less money, and you'll see that actually, accelerating up the chain. And it might take a while before you start to see something, but you don't really get hit by it. But that's the big, that's the big, how can you call it? It's kind of an organism moving slowly towards something. And that's where the business cycle that it goes up and down based on a lot of people, millions of people's decisions on a daily basis in a zip code, where they live, what they stand in front of, the kind of feeling, the sentiment, what happened to their neighbors yesterday, what happened to their husband, what happened to the whatever it's going to be. All these things are what makes sense to them on a daily basis. And that is what drives the economy. It's not the fancy theories out there, and it's not AI. those are facts of life, but they are not the drivers. The driving force is the consumption. Back to from the beginning, it's the big C and the GDP, and the big C is dependent on Mrs. Johnson, and if she doesn't feel well, or we have to understand, in different levels, different tiers, or whatever we should call them, different consumer levels, that you'll see that there is a weakness there, and it always starts housing market, labor market. When you see it coming to the labor market, we're getting close. Now we see the job loss, and it will be enhanced. I think people will start to pull back even more, and that's also why inflation is not a problem, because people are holding back, and that's the problem.
So we're a little bit over the halfway point, but what I want to do is I want to get into a whole nother topic around this allocation this reallocation of assets that's going to transfer, because that's a whole other topic that is a force. I want to hear how your frameworks think about some of those things. We've talked a lot about the employment market. I want to highlight a brand partner. We'll move right through it. Pebble is someone that I use, PEBL. If you are hiring abroad, I don't care whether you're in Copenhagen and Denmark and you're looking for U.S. talent, or if you're in U.S. hiring in there, it is a nightmare if you've ever done it. I've done it. I've had developers all over the world have different things in the businesses. Whether you're a small business, an advisory, or just an entrepreneur building something as a solopreneur with AI for the first time, you're going to hire people at some point, including yourself. I recommend taking a look at an employer of record. Pebble is one of the first. They invented the industry. You can hire in over 185 countries in minutes. You can have payrolls come out of one check and then be distributed in local currency without any headaches. It's $3.99 a month per employee. It's a great deal. That's what I pay. You'll pay less. If you're interested, I think they're doing a 25% discount right now this month. It changes each month, but just check out highpebble.ai if you're hiring people, or if you're looking to get compliance out of your core and into something that you can just outsource. It's a great solution. Highpebble.ai, HIPEBL.ai. Thanks for always being a great supporter of our pro subscription and also our show, and bringing us guys like Henrik. So, all right, there's the mid-roll. Let's get back to something around this $124 trillion, according to Cerulis, I think was the source for that, is going to transfer over the next 22 years, right? So that's boomers to someone else, right? Just in that macro, that's $5 trillion a year for 22 years is the estimate. Is just going to change ownership. Now, I'm not saying it's going to be worth the same amount. I'm not saying it's going to be worth less or more. The reality is the aggregate number is $5 trillion a year for 22 years is going from one set of human hands to another's.
Mm-hmm.
And that is happening now. That's already started. And so when you think about that level of wealth transfer, it's unprecedented. Now, I've written at length about the leaks that'll happen, because there'll be leaks, there'll be confiscation, there'll be predators, there'll be all these different things that happen. But let's just put it in the world of your lens, which is what happens in the real economy. So in the real economy, what happens is Gen X's typically become the administrator. They're not the administrator because they expect the inheritance. We're the first generation globally that grew up kind of without expecting inheritance or entitlements for all the obvious reasons, right? We're kind of the nomad generation, if you've read Neil Howell and William Strauss's book, The Fourth Turning, and ever. And so we are the pragmatists. We are that. We don't have an expectant of inheritance, but what we don't want generationally is we don't want a headache, because we got enough. We got kids in all-time high tuitions. We're feeling more unsafe than ever about their futures. We got parents who we love who benefited as boomers from this last 40 years of money printing and an opportunity, and they own their house free and clear, and they had a job, and they still have a pension. However, they also are transferring this wealth at a time where they're going to live longer. Their cost of care is going to cost more. And there's all these things happening. And while that's happening, we're trying to figure out how to put gas in our car and eggs on our table. And if we're going to have a job. And if that job is going to change or what it's going to look like. And so there's a lot of pressure already on, call it the midlifer. And they're going to be expected or become the administrator of this massive transfer, which is a great burden as much as it is a gift. And inside of all that, you're going to have more real estate dumped on the market in America, for instance, in places that maybe me and my sister don't want to move to, or don't want to manage, or don't want to live. And as that happens at scale, you have to wonder what happens to prices. Because if she needs money and I don't want the headache of a second home that mom and dad just left us, we're going to sell it. And, it's kind of free money. So we might want what the market wants, but at the end of the day, holding on to it longer than we want is not a good thing. But who are we
Mhm.
going to sell it to? Right? Because a lot of it's in 55 and up communities, and you have this next demographic that's not 55 yet, and they have kids, and they don't even know if they want to own a home. Certainly not at today's
Mhm.
price. So I'm just
Mhm.
curious is how you think about or how your framework calculates in these maybe black swan forced selling events that are just pure pragmatism, not something broken in the interest rate market, that are just purely like a cleansing of stuff and clutter.
But I think that is exactly what it takes in. Because again, by the end of the day, what the business cycle, my approach, the indicators do, is that they take the aggregate demand of these things and pull that in. And I cannot calculate on, 2, 5, 10, or whatever, people, or, even a country or something. We need to look at the greater picture, and we need to look at the aggregated demand of things. And that's where you come back to the macro numbers. And if there is a surplus capacity of something, well, then you'll see there will be a price pressure on those things. And if that's the case in certain areas in the U.S. and elsewhere, and these are not so interesting in terms of for people to live there or whatever, well, then of course there will be a downward pressure. What speaks against that will then be, of course, the amount of money, and that's where we come back to the liquidity and all that. It will not keep everything afloat forever. That's BS, to be honest. I mean, I just want to say that I cannot disagree more with that theory on that basis. But if you look at it, it's like the water level in the I'm sitting here looking at the water actually, and you see that the boat, when the tide goes in and out, you'll see that it actually lifts the boats up and down. And that's the same with the valuation levels of houses and so on. So when there's a lot of liquidity and the sea level, you'll see that everything will be lifted up, and that's the prices will be lifted up. And that would be the way. That's the reason why there is a general pressure in terms of moving, lifting, or holding fixed assets also, because in the long term, yes, inflationary forces will push up and lift the valuation of this. And even if there's not for some time a demand in a certain area, well, then they will adjust, and they will, there will be a down pressure for some time. And then all of a sudden people want to move back in or whatever it is. So the prices come down to a level which people can afford. But you cannot sit and take everything out on like this and that. And it's more into the general aggregated demand of things. Do we see that there is an aggregate demand of things in capacity, and what else? Will that create a downward pressure on prices? Will it create a downward pressure on the economy? And at this point, if you ask me, and then not speaking just about houses here, and I mean, actually, not particularly about housing, but about the general economy, what we have seen is an economy that after COVID was pumped up on stimulus, where everybody was making money and reaching their targets. I mean, I didn't speak to many business managers who didn't say, well, I'm 20, 30, 40% above my targets. And what it was. That was why we also saw the price pressure, because people had money in their hands they could spend, and they did spend. Then all of a sudden, what happens then is that capacity will meet demand. But people were building up capacity. What you now see is that demand is not there. And that's why if you look to and you talk about the capacity thing, which on a general basis, again, which is part of it, when you talk about the capacity in the US, for instance, you can see the capacity utilization is very, very low. And everybody's waiting for that boost that's going to come. But the capacity utilization of US manufacturing companies is now rather low compared to what you've seen into recessionary periods. That is not a good thing, because that puts a downward pressure on prices. Again, an indication that prices will not be going up. They should be going down at this point, because everybody was building capacity after COVID. Nobody really understood that it was the macro effect of this, that we had a stimulus coming in. The amount was unseen. It was many times bigger in Europe also, just from what the US was so kind to provide for the Marshall aid back then, when we had to rebuild all of Europe. Stimulus, dollar to dollar in, denominator in the right, measured in the same manner, in the same way, was actually much bigger into COVID. So a massive stimulus came in that created a lot of capacity building. That capacity right now is waiting idle. And what happens is that you see that puts a downward pressure on prices, because people and business don't like just to invest and then start to take that capacity out. So they will wait and see whether it's people, whether it's another factory unit or whatever it's going to be. But they don't like to just take that out again and then actually realize, oh, we did that. That was in vain. We didn't need that capacity. So it does take it in that kind of way, but it doesn't take it in like on a more disaggregated level. It's a very aggregated perspective.
So let's talk about like granular. You're writing, you're growing, you're a bestseller on Substack. There's obviously a reason for that. Talk to us about some of the value because we got 166 and growing in the live right now, which is a great thing. Thanks everybody for tuning in. Feel free to throw some questions. I'll get to some of them if I can, or if I think they can add to the discussion here, and I'll appreciate those and give them as much consideration as I can. So I'm looking at that chat. If you're listening to it on replay, and you're not familiar with Henrik, I encourage you to subscribe. I think you have a bunch of reasons why now in the first 60 some odd minutes. So please do that as a favor to me for thanking him for being on the atomic level. What do they get when they subscribe? Are you giving names? Are you like, what is the juice that you're providing? So the framework is kind of how you arrive at the recommendation. Are you providing recommendations? Are you providing a framework for others to find their own? Talk to us a little bit about kind of what Substack is inside of your portfolio of offerings and why, those who value it are using it and how.
Well, so first, yeah, sure. I mean, of course, there are things I need to keep and hold on to myself and to our executive clients that we have. But what I do on Substack is obviously showing my understanding of things based on that. It's based on the business cycle model. It's based on the framework in general, and it will give you an idea of where are we in the economy. I mean, it's really something I find is interesting to see that very few understand, that you can actually plot where you are in the industry. And one of the things I'm working with is actually that when we understand that there is a business cycle like this, and we also hear that history repeats, or at least history rhymes. It's not the same. If you go back in history, you will actually be able to see that the economy has been at a point like what we see today at different times as well. We'll say, yeah, but didn't have AI. No, but there was another technology coming up back. In the internet was quite substantial, quite something else back in the days. And if you start to look into that, you can actually compare the valuation levels in the market, the labor market, the bond market, bond yields, and yield spreads, and so on. And if you take all these things, and right now we're building a model there that will actually compare to any given time back in history and give you the most likely scenario that this resembles as we are right now. And if you are there and you say, okay, so it resembles like right now, actually it becomes more and more clear that this looks more and more like 1999, and that the economy is weakening, but the market bubble is now so big that we have to compare to 1999. And so you can start to make these comparisons. So this is one of the things also that you will here. Computer just times out or something. So this is some of the things that I write about, and obviously also I love history, and I love to pull history into this. And also, again, the day before yesterday, I wrote about what we could actually learn and understand from what we saw in the whole setup around the French Revolution as we had the Bastille Day. And so that's some of the things I do. And but I write these are articles. I don't dare give that kind of information on Substack that, this is where you exactly are in the business cycle. I do have a service also where I put up a 15 minutes weekly video where I give them the understanding of the economy and where I see the markets and how high you'll see the markets move from here. I've been pretty spot on with let's say at least with equity markets on since 22. I mean, I had 25, 26 and so on. Every time people seem to be thinking that now the recession was here or we were having a major bear market, I could dismiss that. And that's some of the things I give there as well. And that's that's more
on that point, because I see a couple common questions in the thread.
Yeah.
So Michael Connor, Mark Jones, thanks for submitting those. I've seen some others, but two different people must be subscribing to you at some level. But they said, do you still forecast the final blow off top in this market? And if so, what is the impact on cryptos and also other assets? And then one is it still coming, or are you kind of seeing something that tells you it's not coming the way that you had forecast earlier? So those are some of the questions that are in there related to what you're talking about right now. So feel free to weave an answer into that on where you see the market as far as a blow off top, since those are specifically in a bunch of people's minds.
we're 100% in a blow off top. And again, it depends. When I started to use that term, and I did that already, I'm going to say that 22, because we were working in technically terms, we were working into the final thrust higher, and that could have lasted 2 years. I did not foresee back then that it would last like what we did. I said 6,500, 6,300. I said that first, and when we get closer, you can kind of see, and that's technical things. But I never said we're going to be at there, and then I said these are the levels. So right now we are in a blow-off top, and you don't need to take my word for it. You can just look at what you see in the Kospi and what we have seen in the semiconductors and so on and so forth. And if you think those kind of Eiffel Tower rallies are something that goes straight up and they keep going up or they level out, they never do. You will actually see that they come down quite strongly at some point. Are we there? No, we're not. Because if you look to my framework, and that's where it says the economy is very weak. And that's what we don't hear. 514,000 jobs and all the things that I've mentioned. But that's not the same as the economy is rolling over right here, or the market is rolling over right here. We are not seeing all the pieces of evidence. We need to see that now the market, the money managers out there are starting to fear that we have an economy that is. I just had a big event canceled, actually, because I said, I want to talk about this in September in Asia. And they say, we will come back to you if it's more acute. And I think, okay, that's actually a good signal that people are seeing. Simply the sentiment is not there that we see something, because and I did not call for the tops just there, this year or last year and the year before, so on. I said we need to see the certain things. We need to certain indicators that need to flash. One of them is, for instance, just the ratio of, if you take the SPX versus the bonds, and you say, okay, what is that ratio doing? As long as that rises, you normally see 2 or 3 or 4 months worth of a decline in that ratio before you see a major top. We don't see that yet. This month, actually, we still see you're pushing up higher. Does it mean it could not happen this time, but we got, all of a sudden? That's not how it works. Normally, the top comes in because the money managers start to say, oh, maybe it's a good idea to buy some bonds here. And then you can actually track that. You can track the bond volatility. You can track a lot of things and say, are we actually at a point where I would be fearing a market top right here, right now? Actually, no. If you look to the Elliott wave, which is one level of my Elliott wave, and I call it a structured, multi-dimensional Elliott wave model, which means it's not just one market for 1 hour or 2 days. It is actually hundreds of markets that I've been, or different assets, I would say, that I've been trying to calibrate and to understand how do they work, against each other. And if you do that, there's no indication that we are at a market top right here. And I think the next phase actually can be quite strong. And I could see 50% move in the Nifty, for instance. Why does that? Is that interesting? Yes, because in 2007, you actually saw into the final phase a very, very strong rally as we saw the dollar declining. Remember what I said before? Dollar, I expect to decline here before it hits much, much higher. So there'll be a lot of upside. And the moment when I sit on, and I do on Twitter and X, I say, well, I think we have a market top here, and everybody will just, rolling me over for just with comments that I'm just a perma bear or whatever. I mean, that's the moment we're probably getting closer to it, but there's no indications right now. So we're going higher, and but that does not mean the economy is great. It means quite the opposite. I think the final thrust here.
It means we're not having the heart attack. We're not having the heart attack yet. We're still showing off the muscles, is what you're.
Yeah, we're still showing off the muscles. We're still okay, and we will also still. Everybody will believe that the Fed will standing behind us. That's not what we hear right now. But I think there will be a shift in tune from the Fed soon because of what we saw with inflation. There's no inflation. It's not a problem here, and it's and also what we see in the job market, which is a problem. But they will, and when they come in, only the anticipation or expectation of cuts will make the market go straight up, I think, and that is the next phase.
I want to shift into your thoughts on the bond market, especially the long duration end of the curve, because everything's really moved to a really historically unprecedented front end heavy weight. And, a lot of folks are talking about that. I'm curious how you think about what you just said in the context of the bond market as an opportunity or as a de-risk early move if you're just looking at preservation of capital versus maximizing appreciation. Diane had a question related to that around her 401k and savings. Would you recommend being invested in longer term bonds, and at what point do you suggest we start doing that? If we're not at the top, and if we have reasons to believe that we could go much higher from here. Talk to us about what your thinking is related to the bond strategy in the portfolio, and where in the bond durations you think there's a mispriced opportunity.
Well, I think that when everybody expecting inflation, it's not there. I mean, then that probably is a good opportunity in the bond market, and especially if inflation is going to plummet, like I think it's going to do. And we are where we are in the labor market as well, where the labor market is as weak as I see it is. So if that's the case, then I think there's a mispricing of the entire bond market. And maybe that's why also Mr. Buffett, who I have a great respect for, is starting to pile on with that. I do not know about people's risk tolerance there, and that's the problem always, right? Because I have a pretty good tolerance to risk and to also to drawdowns, and I don't have a problem with that because I follow my model and my the setup that I think I can see in the different markets. But it's not the same as everybody can do this and will do the same. And I'm probably not representative of most of your listeners here. So I think it's not prudent for me to say what is right, but I will say that we are at a point where bonds and inflation and the expectation of um, that stock markets can keep going up forever, and all of this is probably telling us that there's too many people in the same side of the boat here. Even though we don't see that particular ratio I was referring to just before actually showing that, which means that this month or next month even, or even that month after, could be the opposite. The opposite could be the case. But I would say that at some point when we see those flashing, those ratios and these indicators, then there will be a fantastic opportunity. And that will probably be in the long end first. Of course, it will be the short end that will start to drop first. And when we see that and we see the yield spread, the 10 years, 3 months or something like that, starting to widen. We see some of that right now, but it's not to the degree where I'm concerned that this is the big thing just yet. We can be, I think we're months from it. We're not many months, but we are. And that's where I say, again, it depends on how early do we want to be. And if you're Mr. Buffett, you're seeing he's out as much as he is. He's in a lot of cash and he's buying, treasuries. So I think it depends on one's risk tolerance. And I think for now, for the ordinary person, it will be fine. It's good and say, well, probably bonds will not be too bad here, and especially if the inflation has topped, which I think it has.
I'm going to paraphrase a question Garrison submitted and kind of frame it into my own thought because I was going in this direction. So we'll kind of kill two birds with one stone. I'm not sure if this is true or if it's just in my feed, but it feels like to me, and I say that because I'm not certain that it's true. It feels like to me that we've been quieter from the camp of Scott Bessent and the like in the last several months, comparatively to call it the first 12 to 15 months. There was a lot of communication. There was a lot of kind of being out there on the press, on the panels, in the news, it feels like to me, and it could just be the algorithm treating my feed differently for any number of reasons, right? Feels like to me there's been a little bit less of that. And so whenever that happens, my brain kind of organizes around, okay, we're being quiet because there's things that are happening. Either the table's been set, now we're letting it play out, and we don't want to ruffle, or something is not sorted yet, and so they're going to wait. And so I just notice it. I don't know what I make of it. I'm just telling you how my brain works. I'm curious, do you feel similarly? And then with Warsh, do you feel like maybe that's just intentional to kind of let the monetary side of the equation and under new leadership kind of have its chance to get its footing and make communications or give guidance in a way that isn't being contradicted or glommed together? How do you think about those two sides, Treasury and Fed? And then where do you think July leads us? What do you see unfolding there?
I am not sure. I'm not sure I could talk much about what happens with the Treasury or the communication, all that.
Do you feel like it's been less, or is it just me?
I was just thinking while you was talking about it. Maybe not been paying attention to it because I don't honestly pay attention to what is being said. I look to the numbers and to the structures and to the developments instead. So maybe I would be. I'm not sure I could add a lot of value there. Honestly, when it comes to Warsh, I think that the situation is, of course, that you cannot get into that position with him and then all of a sudden he just changes direction immediately. I mean, that would that would be very wrong, right? Then like saying Powell was wrong. I say Powell was wrong. He was very, very wrong, and he was very late. And
I
it's
tend to agree with that. I would tend to agree with that. Without it being the other is right. I would tend to agree that Powell was wrong. You know.
there's no doubt. There's no doubt. I mean, it's like you trust your numbers too much, and then actually Wall's coming in saying, you don't we don't actually our numbers are not very up to date, so to speak, and all these things. And I think that is a fair assessment of things as I understand them as well. So there are many things that could be done. So let's see. I mean, the judge is still out on what that can lead to. But of course, they could not just change direction immediately. That would be very, the stock market could really, and the economy could react to that and say, "Oh wow, we've been running out the wrong road there," and which they have. So I think there will be a change of tune in terms of where we are and where we stand. But it is also because of the reality that we're seeing. I mean, we're seeing some, as I said again, 514,000 lost full-time jobs in June. That is not a small thing, which is not in the news. And again, also the levels we have been. It's not a new thing. I mean, it's something, as I said, 24 October, November, it started to come down. You could see that there was all of 184,000 jobs were created. That's lousy for a U.S. economy of that size, right? It's standstill and it's even stalling. So that to think that all of a sudden it's accelerating here, I don't know where that acceleration should be coming from. All of a sudden that we see 20. But I think the numbers that we see here, also with the revision we see in August, I think it's going to be terrible. I think you're going to see a huge amount. And if that comes out, and if Walsh is, I can't remember pronounce the name, is coming out with that and with real understanding of the situation, then you probably will see that there could be a change, and that will be, again, as I said, all of a sudden investors will realize, oh, we got the Fed behind us. Actually, they're not providing the headwind for us. They're actually going to provide some tailwind for some time, which can bring the markets up. But that is when the fat lady is going to sing from the real economy. And I think that is where the third phase, the contraction phase, is going to take over. So I think,
I almost wonder if they feel like if they can hold where they are and the market can go up. And I think about this through the lens of now the political side, right? The risk of the real economy getting more disconnected is November is right around the corner. And so midterms are already going to be impacted by all of these other things. And one more problem doesn't bode well for the current administration or the current mix in our Congress. So part of it is, will we see much change at all? Because if somehow we can get this lift off of good CPI prints, whatever, right? And we can get this up then we get to claim good economy on the headline, right? With the market. But we don't have the same disconnect at the real economy level that could make November a problem for those who don't want it to be. And post-November, it could be whatever, right? Like if you needed to let something happen that you should have let happen in September, then you do, and because it's over. So those cycles always play into my mind when I think about these things, not because they're actually data fundamentals, but because they are forces that dictate when data gets released or when it gets revised or when guidance is given in a certain way, right? And so, I guess as it relates to just what does it mean for commodities, let's talk about supply and demand related to that. Like, what are your thoughts, or where does your business cycle framework look at and account for the supply demand and issues related to commodities? Because there's a lot being written now about the constraints of all these bits and this exponential growth and CapEx spending.
But I think you said it.
Right? Is relying on, we have a scarcity of atoms.
But I think you said it. When a lot has been written about, and I think that when everybody knows that there is something to this, then probably that's a little too crowded of a trade. I don't think commodities is a good play right here. I do think there can be a bounce both in precious metals and also in commodities going into what would be, as I said, a decline in the dollar, but it'll be driven more by that. But I don't think that and this is again where we talk about different perspectives. Which perspective am I talking about? Right. So if you talk about the next 2 to 3 months, I think you can see a bounce in gold and silver and in other commodities, as well as the dollar is going to decline. That would be a natural thing to see because of that. Do you think that we have a situation where commodities is going to do well straight from here? No, I don't. And I think actually you're going to have a very, very strong decline in certain commodities because there's been this whole, again, notion and talk about it. Talk of the town is this. How often that develops in the quite the opposite way. Furthermore, I think when we have had my decline in the dollar, which I think is going to do 93, 94-ish on the Dixie, well, then I think the dollar is going to rise and going to rally a lot. And this is the one thing that very, very few people actually at this. I mean, I talk to a lot of people and they say, yeah, we have to see about this with the dollar rally that you talk about. To me, it's actually one of the strongest charts that I have is that we're going to see a very strong dollar rally. And if I'm there, if we get that, you're going to get a pullback in commodities and precious metals that is much bigger than what we have seen now. So I don't think the commodities game is here. And the commodities game, back to my model, is in the second phase, in the slowdown phase, because that's where inflation normally comes in. That's where you see that the commodities will do well. And then people will be all into that and all the talk of the town, as you just said, as much has been said and written about it. Well, that's probably a good tell sign that you have reached what I think is the top for now, because as we then look further ahead and we see what comes next, of course, you cannot just sit and look at that. But then, of course, at some point, the dollar, when this moves up, you're going to see the Fed come in and they try to crush the dollar. And we're now thinking so far ahead. I don't know if this is disconnecting for your audience here, but
no, I think
I
what you're doing is you're reminding us of the framework, and I want to pin that because a lot of people join halfway in. So I want to take as a practical takeaway. Let's talk about that framework because you just mentioned it. So there's essentially, if I remember right, you have 4 indices, a couple of which are proprietary that you kind of look at as far as liquidity and job labor force participation rate. And then you have what you called 4 phases, 3 of which liquidity directly impacts in a positive way, throws gas on the fire, one of which it kind of works against itself. And so I want you to name those 4 because I think as a tactical and a practical takeaway for everyone who's listening that's familiar with what or not, it's really good to ground them in what are the names of these indices that
the 4
you have.
phases.
And then what are the 4 phases by name? Because I want to make sure we really crystallize that for folks because I think that matters. It helps you see where you are in time and what is going to move so that you can take the narrative to your point. If everybody's talking about atoms and bits arbitrage right now and that crowded trade feels crowded, that doesn't mean it's wrong. It means it's not right now. And where I look at the framework would tell me when I want to go all in on that one.
Correct. When I talk about the framework here, I talk about these business cycles that you see right here, right? These are the business cycles so this is the coincident indicator, which tells us where we are, so to speak, with the real economy. And of course, there is, as you said, there's a leading indicator index, which tells me where we're going with the coincident indicator next. When that crosses over, you have now the Titanic has hit the iceberg, but doesn't sink immediately. It takes a while. And when it crosses over, you have a bad time. When it crosses over, you are really in what I call we have the phase of the contraction. The contraction phase is where you have the recessions. And we are now, we are very early in that phase. It was here by 1st of July that the crossover was there. It doesn't mean it happens the day after. But normally we are like within 3 months, you would have a recession. I think it could maybe be 4 months this time for various reasons. And there is not just one thing. There are, as I said, also there are other things. It was just a very short summary you saw with those different indicators also. But in general, that if you look to this, it would actually have told you up here that you should have been, mostly in gold and XLE and then 10% in bonds at this point here. This would have given you that you have 50. And this is again a generic kind of framework that will put you that you should be invested into. I'm not saying this is right for everybody. It's not right, where we are correctly right now, right here. But it's just an indication of that. So in the framework, when you are crossing over, when you're getting into phase 3, which is what we do here and here, well, that is not where you want to be long something like commodities and also equities. When, again, don't wake up tomorrow and say, now it's going to play out right here. But this is actually where you would want to be more on the conservative side. You want to own bonds and you want to own also something, maybe for me, at least as a European, something dollar, an ETF on dollars or something like that, because I think the dollar is going to be very strong. So this is where the phases probably take a little too far here to go into, but this business cycle here could be simply go into 4 different phases, and if you follow that, then you will actually be able to perform really well in the market. As I said, the generic setup here would have created over the last 51 years an outperformance of the market. And this is actually also what I have a dynamic model now that where you can go back in time and say, well, if we were standing in 1999 as the model is suggesting, well, then you could be looking into, and you are in a phase 3, and which assets would you then do well for you? But in general, it would be bonds and cash, and then a little later it would be gold for in phase 3, and that would make you safe there. It doesn't say this is actually the only phase where you do not have an exposure to risk assets. And that's why, because that's in the phase where no matter what you do, it will be, cash is king. And it's not right here, right now. It is, if you go back in time and say 2008, you had the crossover there of the coincident in November 2007. In December 2007, the recession began. The dollar started to rally very, very strongly in March of 2008 up till around October of 2008. And then you saw, and that was the cash shortage phase, you could call, where the Fed then stepped in and started to supply a lot of dollars, which then changed again the phase. So this is we're not in that cash shortage phase, but we are crossing over, as I said. So compare this to where August, September of 2007, where we still had some juice in the stock market, but we know that it's coming to an end. And this is how I relate all the time. So would you be in commodities in a situation we had going into 2008? The answer is no. You probably now 2008 was crazy because you had the whole oil spike into to that. But in normal terms, it would not have worked. And then so not commodities in that phase. You would be into something that is more secure, into in conservative bonds and cash and whatever. And again, interesting to see that's what Warren Buffett is doing, and not aligning with that. I just observe what he's doing, and I can see that as actually I know what the model is suggesting.
Yeah, I think it's a very practical approach because it allows you to kind of zoom out enough to say, where do I want to be allocated for the phase that we're in on the real economy side? You're helping take this financial economy and turn it into an analysis on where we are in the real economy, so I can decide which financial assets and which percentage makes sense for my portfolio, depending on my age, my years in retirement, all those things, right? Because everyone's going to have a different risk tolerance based on where they are in the life cycle of a human being. When do we know that we're in a recovery? What are the indicators do we watch there, and what happens there? Because that's what happens next. And I'm assuming we're early on, as you said, we just crossed over. So we just got into kind of the contraction phase according to your framework, which means maybe that lasts however long that lasts. They're going to be shorter or longer depending on the macro. But what are the indicators that tell us when we're out of that and into a recovery and we first cross over to that? That's what I'm curious about.
All right. But that's good, because that's actually also, that's what we want to know. We just don't want to know when we get recessions, but we also want to know when it's safe to get back into the water. And that's actually also one of the things that we look at here. It's about understanding there are 4 phases, not just when it all turns bad. And what you can actually do here is that you can actually turn this on, and you can see when there is an indicator also giving me, okay, when do we actually start to see that the recovery is strong enough? And you can say that it comes in a bit late, but it's not so late that you're not going to get a strong part of the market. You'll be staying in for a long time. You wouldn't have been in and out of the market. So what the model is, that would have brought you in, let's say Q2 of 2010. That was at a time where people did not expect that things were great. It also, brought you in back in the days, let's say in 1992 here in Q1. What we can look at is really where, this would have taken us if we convert that into the stock market and being in bonds and in stocks, because it's not just about being in stocks or in bonds. It's about being in the right time. And even if you get out here, which the model would have done, it went, kept you in stocks here, it then took you out, but that's actually at the time where it then put you into long duration bonds. And you would have seen that the stock market actually would do okay and then decline somewhat again. But the long duration bonds would have done even better here, or performed better. The same was the situation here. Here you can see in 2000 that it actually took you out around this level, around here, and got you in, as I said, into 2003 here. But again, you would have been long duration bonds, which have made a very good return for you. So in general, if you have followed this model back in the days, and just by following this simple Zeberg-Solomon protocol, as I call it, you would actually have seen a 42,000% return from 75 until 25. This was to last year. And just to make a comparison to that, that was at a time where you would have seen a buy and hold for the S&P of 5,900%. So if you can spot the declines and you can stay long risk here and you can get into long duration bonds these times, then you are pretty well off. That's the first level of this, is really just to don't be long risk assets when you have a recession, because you can spot the recession. And when you do, you get out at the right time. The model tells you when. It told us here in July. Will it be the top of the stock market? No, but it tells us that there is a relative good value now in being long bonds. If you go on and on and on.
I think that's the point you're making is it's telling you when it's comfortable to decide to take profits for phrasing it. It's not telling you have to take profits today. It's not telling you you're stupid if you wait till tomorrow. It's telling you it's safe enough for you to feel good about taking profits and not worry about what happens up from here, because you can predict that this recession is imminent. And so if this recession is imminent, you do not want to be holding the bag then, and you're never going to time it perfectly. So decide if you want to take profits now. Do not wait 4 to 5 months, because now you're gambling. And then move into cash or move into a strategy of long-term bonds that will balance you out, and wait for the signal of recovery to know when you can effectively buy in near the bottom, not the exact bottom, right? Because again, you can't time the bottom either perfectly, but you can know that it's probably on its uptick in a more sustainable way. And that might be 2010 to 2008. It might be 92 to 1989. It's going to vary, but there's this way you can kind of understand. We've crossed over.
Now we're,
and so now it's safe enough for you to realize it could go a little bit down from here. You might lose a couple points in the first quarter when you buy back in, but you're not going to lose that permanently. You can feel safe to get back in the water. And wait for
and it's also what you could use back in 22, and I could go through that, but I mean, if you saw 22, as I showed you before, the coincident indicator was rising. The leading indicator were well above equilibrium. There was no hell that there would be a recession at that point. You had liquidity concerns, but you do not. Mrs. Johnson, she had a lot of money in her pocket because she had to cut stimulus checks, and even though liquidity was pulling back, that was not enough. That was what the model said. People here who knows me would say that is correct what I'm saying. I said, you got to be long. You can find it on Twitter. It's there. In 23, there was the whole banking situation. There was the signature bank thing. I said, this is not it. We are not there. And so you can also use it for saying, hey, okay, so everybody's freaking out. Maybe it's time to buy the dip. In 25, the same thing. In April, I told our clients, I said, well, actually, I think it was on the 7th. I think it bought on the 6th or the 7th of April last year. And I said, this is not it, because we're not there. There is no indication that this is going to be it. Is it coming at some point? Yeah, but it's not here. And we can go much further, much higher, and we will probably hit 8,000 or something. Same this year. Everybody was again freaking out, and we have BlackRock saying last year we have a recession now. They are guessing because there was no indication of that. Then we are at a point now where so also for 25, 26 the same thing again. And I said, no, it's not here. You can buy the dip if you want to, and you can stay in. Now, see, the situation has changed now, because now you have the crossover of the coincidence. But that's not the same as freaking out or running out right now. If you are prudent, you'll start to say, okay, we here, the economy is not well, it's rolling over, but it's not the same as running out at all, because as I said, the forensic can go in, and I think it will. But it will also then bring you back in again and say, when everybody, because remember, people are not saying, oh, this is the bottom, guys. Hey, hello, let's follow me. Everybody's saying, this is going to be deeper. It's going to crash. It's going to go much lower. We're going into depression. That's the time when you actually can see the model start and say, hey, no, it's not that bad. So it's not just about killing out recessions, and it's actually also about being able to buy the dips, because you can say there's no reason why we would see that in a recession or a severe bear market here.
Yeah, I mean, I might be oversimplifying it, but I try to keep complex things
simple. That's good. I mean, we should.
What I think you've got, and it's just my first time ever seeing it, but I think you've kind of got the EKG of real
That's what I'm
economy,
putting in. Mhm.
right? And so we're looking at the systolic and diastolic readings of a heart
Mhm.
inside of the real economy on
Mhm.
these different charts, right? We have these
Mhm.
different indicators that you're looking at, and we're reading them, and we're going, are we healthy? Are we moving towards unhealthy? Are we at risk of a heart attack?
Yes.
Are we ready to go run a marathon? Where are
Mhm.
we in real time?
Mhm. Mhm.
And that's what you have. And then
Mhm.
what I'm able to do with that is then I'm able to see the noise that is
Mhm.
inherently there. Like, let's say Warsh lowers rates. I don't think he's going to. Doesn't matter what Chris thinks. He could. He could
Mhm.
not. But let's say he does. Well, whatever uptick we're going to have in the S&P already, if he
Mhm.
doesn't, will now likely get amplified.
Mhm.
And what you're saying is that the EKG doesn't change. If
Mhm.
anything, what happens is we move closer to a myocardial event. We move closer
Mhm.
to a heart attack because now
Yeah.
the head fake of,
Mhm.
oh, Henrik was wrong. He said we were going to go to a recession and we just hit
Mhm.
8,500 in the S&P. See, he doesn't know what he's talking about. Well, you're
Mhm.
measuring body fat percentage and muscle density, and you're looking
Mhm.
at the attack, and there's a different
Yes.
thing.
Yes. Correct. Correct. So you can look very nice and fit and all that, but it's really about what is the health of the real economy, and it will by the end of the day. I mean, you can be as fit as you want, you will still see that if the heart doesn't work, then you will collapse,
Right.
and
Doesn't matter.
and that's the situation. You can follow that, and that beating heart, and then I like your analogy so well, so much. I want to steal it. So if you allow me,
Well, it's
so
yours.
it's
You
well,
I'm
thank you.
just telling you
But it,
how
but it,
I
it is
yeah,
it, yeah, but it's really that. It's really that. And it's really about understanding that if that stops, the heart stops or it moves into a certain phase, you are not well. And you can think whatever. And you can say, but look at his muscles, look at his biceps, look at whatever. He's in great shape. No, he's not because his heart is stopping. The beating of the economy is stopping. That's what we see right now. Not nice and slow because it's not nice, but slowly we see it, slowly but surely, we see it stopping. And it will bring down the financial markets. And I think this is what people need to understand. And if you know, everybody who talks about you could just print money and they'll do it and then they'll save the market immediately. Just think and see. Didn't we see that before? First of all. Secondly, if we all saying "Yeah, he's not going to lower the rates, how much do the markets actually need to crash? And if, as I remember it, if you can remember when they started to print money big time, first they were cutting a lot back in 2008. If you just allow me to take you back, in January of 2008, the Fed was cutting 125 basis points. Did that save the economy? That was in January of 2008. It did not. They were cutting like crazy because they could see that things were now starting to be bad. And but the stock market had topped at that point, but they were trying to do everything they could from a liquidity perspective, monetary easing to help the economy. It did not prevent the financial crisis. So they will try, but the problem is it's already in the psychology. And think about this time. This time around, you have a situation which is so much worse. You have Mrs. Johnson again, back to her, that has now been underwater for a long time, that has seen inflation coming back, which we didn't see really back in the days of 2008 to the same degree. We had inflation also, but it was not. And she has seen also the debt levels in general is much worse. The debt level for the U.S. administration is worse. The market could is much more you can call exuberant right now. I would call it in terms of valuations. So all of these things, if they now come into that perfect cocktail, I don't think it's going to develop in a nice manner if we got a recession. If we get a recession here, and I don't think that they can actually change the course of thing even when they start to print. Remember, they started in October of 2008. When did we see the market bottom? We did that in March of 2009. But don't tell me the money printing can solve things immediately. Don't tell me rate cuts can do it because we can just go back in time and say, not the case, not the case.
Yeah, and I think it's again, I'm going to oversimplify this, but I think it's important for us to remember that neither one of these things is right or wrong, but we are looking at two completely different economies with two completely different incentives, and we're probably invested in both. Otherwise, we wouldn't be listening to this for almost 2 hours. But we are looking at a financial economy which survives on fees and carried interest. And that is the
Yeah.
incentive. Everything is driven around fees and carried interest. BlackRock doesn't have IBIT because it likes Bitcoin. It has IBIT because it can outperform on fees at 25 basis points by selling out an ETF faster than any other ETF in history. And
Mm,
it can
mm,
create an army of salespeople for this thing called Bitcoin that
right.
nobody
I
understands
agree.
actually own, but that they can monetize with fees. I'm
I
not
agree.
saying they don't also
Mm,
believe in the story. I'm saying they don't have it for that reason. They have it because of
oh,
fees and capital appreciation. So we know this, but that's one macro driver. Politicians use
right.
it. Everyone uses that GDP number of consumption so that fees and appreciation happen. Now, real economy, oversimplified, is about consuming real goods. It's
Right.
about consuming consumables, things that have to be replaced. Shampoo in your bottle, eggs in your fridge, gas in your vehicle. Those things have to
Right.
be created first, and the supply and demand drives those consumptions, and you need cash. You need liquidity in the household
Right.
to do it, or you
Right.
need credit that you can afford to keep. And right now, the real economy is not thriving in fees and
None.
appreciation. It is not thriving in liquidity, and it is not thriving in sustainable ability to have that. With inflation coming down, what you're saying is there's this interesting thing where we are not going to have inflation at the level we thought. And so now we have to figure out how can we create health in the
Mm,
real economy, but we're
mm,
also laying off jobs. We're doing things that are not being reported for whatever reason, they're not being reported at the same level.
mm,
And we're moving
mm.
towards a recession, which means consumption in the real economy will drop, even as
Mhm.
we might see a spike in consumption of the financial economy.
Exactly. Exactly.
I think that's the story that we're trying to
Mm,
unpack today. That's what your
mhm,
framework is uniquely helps us see where we are in that time, where we are in both realities. And then again, depending on where we are in life, we can choose with our advisors or whomever to make more prudent decisions on how we allocate our capital.
right.
So I
I
can't thank
completely,
this dissertation today. I was not expecting this. I always expect something good, or I wouldn't have somebody like you on the show. But I was not expecting this. This was a treat. And for those who already follow and subscribe to Henrik, please upgrade if you haven't, because I think he's given you 2 hours of reasons why. If you are my audience and you are brand new to Henrik, you now have all the reasons in the world to click that button and subscribe to him. And if you're new to me, I would love to have you show up again. So we do these every week. Next week, I've got Mike Green on. I've got Nick Bhatia on. We're talking about Bitcoin. And with Mike Green, we'll be talking all things macro. We'll throw some more stuff in the mix to get you confused even further and hopefully clearer at the same time. But Henrik, it was an absolute pleasure. I'll give you the final word. Thanks for being on the show. And guys, you know where to go and follow him. Thanks for tuning in.
thank you, Chris. It's been a pleasure. And I think, yeah, hopefully people will start to listen to this kind of reasoning and at least take it in and see if that doesn't make sense. So thank you again.
Awesome. Well, all the best. Wish you the best of the last bit of summer there and all those long daily hours where the sun never sets. So
Oh, exactly. Thank you.
enjoy that beautiful part of the world. And we'll see you next time on the Atomic Level, guys. Thanks.